Welcome, everyone, to the residential outlook for 2026. I'm Andrew Liss. If you've not been to one of these presentations before, welcome. If you've been to one before, welcome again. Thanks for coming back. This one's going to be kind of an interesting talk. I'm going to revisit some material that I've looked at in previous years, and we're going to kind of talk about what might be in store for 2026 after what was a pretty, uninspiring 2025. Let's put it that way. So let's jump into it here. Okay. So I like to start these presentations by recapping, how the year went. I think it's an instructive, process, and I think it's also kind of it keeps us honest here about our forecast, or how well we did and whatnot. And I think it's a nice opportunity to sort of explain some of the thinking behind what went into the original forecast and where things went off the rails. So when we look at last year's forecast, this is a plot of what our model spat out. The forecast is in the dashed line, and then what actually happened is in that solid line. And we're looking at this on a monthly basis, which we don't usually publish the monthly basis forecast because it's sort of like one of those things, you can see from this chart that every month, if you're kind of off, well, people are going to be emailing you, hey, why are we off with it? So we publish an annual number and we try to trend towards it. But under the hood of it, it looks like this. And what I wanted to show here was that, like last year, there were things that were happening at the end of 2024 that set the year up for what we thought was going to be a much more stronger year. At the start of the year, back here in January, we were coming off of 2024 with a number of rate cuts, and it looked like momentum was picking up in the market. We were starting to see the last few months of 2024, they were starting to see like some momentum building, or at least it felt like it. And the numbers certainly reflected it for at least a couple months. So our forecast spat out a number for January, and you can see we came in pretty close in January. But the problem was that as the year evolved, the gap started widening between our forecast and what was actually happening. And one of the weirdest parts about last year, the one that still is very difficult to put a finger on exactly what happened, is normally, just purely from seasonal factors, we expect a lot more sales in that spring season. It's one of the busiest seasons of the year, just purely from a repetitive standpoint of the data. But you can see the gap there by the mid-spring was pretty wide, and that gap unfortunately persisted for quite some time, right about the summer, where our forecast started coming in much closer to what we expected. But the summer was kind of a slow point. And then, of course, we had the second half of the year where we expect usually a bit more of a bump in October. Didn't really happen. And so, that huge deficit that we had at the beginning of the year in 2025 really carried into the latter half of the year, where it was like to make up the ground that we had lost over that point in time would have been very difficult. We would have needed a huge number of sales to come back in towards where our forecast was originally placed. And you can see it just didn't happen. And that second half of the year didn't help much either, in that it came in a lot softer than what we'd expected. And so it was a tough year for the market. And we'll talk about, I'm going to try to get into some of the reasons why I think this occurred. But before we get there, what I thought would be kind of interesting to do this year, which I haven't done in previous years, is compare what we're looking at in 2026, our forecast, versus what we expected in 2025. So here, the dashed line is no longer the forecast. The dashed line was last year's forecast, and the solid line is this year's forecast. And I'm giving you this in the month-by-month basis. And what you can see here, the reason I wanted to present this, you can see some of the contrast here, is that like our forecast this year looks a lot like the actuals of last year. And that's not exactly an accident. What we've seen so far this year is, in January, last year's forecast expected numbers to be almost around 2,000 sales in January, whereas this year we were expecting only about 1,000. And the actuals trickled in at around 1,100. So a little bit above where our forecast was heading. And part of the way that I built the forecast this year is a little bit different than I've done in previous years. I run this suite of models, hundreds of models, and basically it's a battle royale of models. They compete with each other for forecasting accuracy. So I let all these models loose, and then I pick the top performers. the ones that were the best at forecasting the future over this historical time frame that I run it on. And one of the models, the workhorse one that I've used for many years, is this what I call sort of a structural model. And it understands relationships between different segments of the market and prices and all of these other factors. And it has this like understanding of relationships about how the variables in that we care about here, like sales and prices and things like this, how they relate to each other. But what that model tends to do is it tends to want to predict, kind of the average over long historical periods of time. Because if you're playing a betting strategy game, that would be the most favorable betting strategy, is to usually bet on, the middle ground or the average or something. And you'll probably win more times doing that than you will taking the outside bet. So that's why that model tends to want to predict things that are kind of close to, historical averages, although there'll be some variation around that. But another way of modeling things that you can do is you can use models that are kind of agnostic of relationships between each other. And one of the ways you can do that is use models that are called autoregressive. So what they basically do is they just look at historical data points for a series. So if I'm talking about sales here, it just looks at previous sales numbers and say, based on previous sales number, what do I think the next number is going to be? And it uses some fancy little math to do it. And it's very simple. But one of the benefits of those models is that they understand a concept of momentum. Whereas like in an autoregressive model, it's unlikely that you're going to get a forecast where the number jumps from, say, 1,000 in January to 5,000 in February. That's not really going to happen with an autoregressive model. It's going to give you a much more gradual transition to some higher number at a future date. It's not going to do it by jumping around as much. So what I've done is I've kind of merged these two worlds a bit of models this year, where I said, okay, well, given that momentum is slow coming out of 2025, I'm going to weight our forecast towards a momentum model for the earlier parts of the year. And then I'm going to weight it more heavily towards this structural model towards the latter part of the year. Because the momentum models are quite good at capturing very short-term dynamics, but they're terrible at long-term dynamics. They're horrible at forecasting 12 months out, but they're very good at forecasting 3 months out. Whereas the structural models are kind of good on average at all of them, but not perfect. So like I said, I thought this would be kind of instructive to point this out, that like the difference this year is that the momentum models are saying the first half of the year is likely to be a lot slower than we had expected in the previous year. And you can see that by the spring, the momentum model is sort of saying, don't expect fireworks at the start of this year based on momentum trends. Now, of course, anything can happen. There's all kinds of factors at play, which we'll talk about just in a moment, that could change the trajectory of these things. But it's giving a very different picture than what the structural model would suggest, essentially. And you can see these models are starting to weight more towards the structural model in the latter half of the year. And again, we do sort of expect a slower, softer fall market than what we would typically see based on seasonal norms. So I thought it would just be kind of interesting to give you a flavor of where we're coming from on the forecast this year from a modeling perspective. And I'll talk about a lot more about where we're coming from on it from a kind of, economics and just sort of like factors that impact the market kind of perspective in just a moment. So I'm going to get into various things that I think are influencing the market and try to also highlight what catalysts might remain for the market in 2025, because or 2026, sorry, as you can see from our forecast, it looks a lot like last year. And so, we are kind of expecting sales to be a bit subdued this year. So one of the things I've talked about, I wrote about this like a few months ago on a piece called Uncertainty up on the economics blog, which if you are new to this space and if you haven't found our economics blog, just type in GVR economics in Google and you will find our blog very quickly. And, I wrote a piece called Uncertainty where I saw this chart that was this one here somewhere in social media or something like that. And I pulled the data myself. I looked at it, I said, okay, well, that's interesting. There's this huge spike in this so-called level of uncertainty in Canada. And this metric here, the way this is cobbled together is it largely tracks references to words that might imply uncertainty in all kinds of sources of things and, books, media. And I think one of the issues with this metric today is that increasingly it's going to skew towards things on social media, which of course, there's been an absolutely ballooning amount of information that would suggest a heightened amount of uncertainty in recent years, particularly right after about this point, which was the inauguration of Trump in the United States. And so, yes, a tremendous level of economic and political uncertainty was introduced at this point in time. Right after Trump was inaugurated, of course, he starts tweeting about tariffs and this and that, and we hit this mega high point in this chart that we'd never seen a reading so high. But I question these kinds of things because, as I said, it could just be picking up on kind of the fear factor of social media and this kind of thing. It could just be sort of not a really good, true indicator of actual political uncertainty. It could just be a kind of pop culture indicator of political uncertainty. Whether that matters or not for the market is a question I'll examine in a second. But one of the reason I wanted to point out this chart is that we're at a point now where this metric had spiked tremendously, but it's down now. It's down substantially. It's down like, more than half. And if the argument is that uncertainty was the weighing factor on 2025, then kind of the counter argument would be, well, if uncertainty is unwinding, wouldn't that lead to an increase in sales then? If it's uncertainty that's dampening sales, you would think the reverse of the mechanism operates. Well, this is why I was skeptical of this thing to begin with. When I looked at this relationship historically in that piece, uncertainty, I took our historical sales and I looked at, the changes in sales over time. And I did just a simple linear kind of relationship between these things to examine the correlation between these two variables, the economic uncertainty index and sales. And it turns out, while the slope of this line is heading downwards, as you would kind of expect, you would hope. So what that means is that very large readings in the uncertainty index tend to be associated with periods of slower sales. The problem is with this plot and this kind of relationship is that it's extremely weak. This R-squared number here is a measure of the linear relationship between these two variables. It's a number that's bounded by 0 and 1, 0 meaning there's almost no relationship between these data at all, and 1 meaning there's a perfect relationship between these two variables. And as you can see, a reading of 0.05, that means like 5% correlation between these two things. It's not super strong. And it wouldn't be if you were betting in the stock market or something, and you said to a buddy, oh, I found a metric that relates with the S&P 500 5% of the time, it's right. You wouldn't exactly go designing a betting strategy around that because it's probably going to lose money. And so this is sort of the similar concept here where it's like this, while there was clearly a very marked, huge increase in this uncertainty index in recent times, and it is certainly possible that had some impact on the market from a historical basis. Like, if we were to play this game 1,000 times over, this data is suggesting that there really isn't much of a relationship, and that relationship, if there is one, is not very strong. So that might explain why we're seeing, the uncertainty index coming down, but we haven't seen sales picked up significantly as a result. It's because there's such a weak relationship between these things. So I still remain skeptical of the notion that uncertainty is the primary driver of what slowed down the market in 2025. I certainly have a hard time denying that it had any kind of role to play, and I'm certainly guilty of going on media and saying uncertainty, because it's very hard to distill what I'm going to show you in the coming slides in a 15-second soundbite to media about the other complexities going on underneath the hood of the market, which I think are probably more realistic in terms of actually driving the issues that we're seeing at the moment. So one of the other things that we had, and this is kind of an interesting way of looking at our 2025 forecast, was that in 2025, we had expectations that the Bank of Canada was going to lower the policy rate, which they did. You can see in this chart, there was 4 rate cuts within 2025 there. And coming up into 2025, you can see just before that in this chart, we had a whole number of rate cuts and pretty significant ones as well. And I think that was part of what led to that momentum at the end of 2024. People were starting to see mortgage rates really come down. Some people were starting to re-enter the market. And we had these expectations. We had the wind at our back from the Bank of Canada in 2025 with regards to having at least some, there is a fairly strong relationship between mortgage rates and sales. When mortgage rates hit the floor, we tend to see sales pick up, quite significantly. This is a pretty strong relationship that holds true in the data for long, long periods of time. And so in 2025, we really had the wind at our back from this perspective, because we did actually have policy rate cuts, and we did see mortgage rates come down a little bit. And our expectation, for the 2025 forecast, that's why it had that sort of bullish tone to it, was like, well, we're going into a year coming off some momentum of 2024, and we've got rate cuts that we expect. So, reasonably speaking, most economists, and if you look across all the forecasts as well, most economists were in agreement. We were going to hit somewhere around 30,000 sales for the year or something. Didn't happen. Now, in 2026, this is the trouble, is that as much as I would love to say we've got the wind at our backs right now, it's really only a result of mortgage rates being in a kind of like not super high territory. But the Bank of the forecast on the policy rate going into the future, at least for 2026, is maybe a rate cut, maybe a bit of a lift towards the end of the year. There are a huge number of factors right now spinning around the world that are somewhat concerning to this forecast. This is taken at a point in time, and it's based on derivative markets that bet essentially on where the rate's going to go in the future, which I like because it updates rather dynamically in time. But even, the Fed, the US Fed, they've got a new Fed chair coming in who is probably going to drop the US policy rate significantly. And historically, the Canadian Bank of Canada, the Bank of Canada has often followed suit. But we're in a weird time where, Canadian politics and US politics have never been more divided. And, central bank policy we'll see how divided they are. Historically, they've been very correlated. What the US does, we tend to follow. This time around, I don't know. In a culture of elbows up and all this kind of stuff, I don't know. I really don't know where we're going to go. So looking at this, though, from where derivative markets are pricing it in, they're saying, maybe a rate cut, maybe not in 2026. And as you can see, this is floating upwards after 2027, which don't put too much stock into that part of the forecast. That is extremely hard to forecast rates out that far. Derivative markets get this wrong all the time. But also, like I just said, we have this totally unknown, uncharted territory that we're walking into right now with a new US Fed chair who's probably going to be kind of doing whatever Trump wants, essentially, or more towards that end of things than being somebody who's resisting whatever Trump wants. So it's going to be interesting times as to what might happen to interest rates and by relationship to mortgage rates. But as far as we can tell right now, and the way that markets are pricing things, it's like 2026, we don't have expectations of a tremendous amount of rate cuts. You could have a major recession or something like that might bring down rates, but that's not necessarily good for sales and the economy in other respects. So how this pans out is going to be an interesting one. But like I said, at the moment, we don't really have the wind at our back for 2026 in terms of expecting more rate cuts. And that's part of why that forecast that I presented to you earlier is not as bullish as you might have hoped for, essentially. Another factor that's been going on that I think is, I'm going to focus a bit more on the population side of things in this presentation than I have in previous ones, because I think this is actually where we have some rubber hitting the road of things here in Canada. So this chart, I'm going to show you a chart of cumulative population growth by decade. So as a first example, here's the 1960s. And what I'm doing is I'm saying every quarter, there's some amount of people that came, that Canada grew by. If I take that amount of people, say it's 100, and I add it to the amount of people that it grew in the next quarter, I get a line that just slopes upward because I'm constantly adding people to this line. It just makes an upward sloping line. And as you can see, you go from adding about 0 people at the beginning, because we're at the beginning of the data series. And by the time we get 10 years out, 40 quarters later, we've added a little over 3 million people in the 1960s, maybe 3.4 or something million people over that decade. And if we go to the 1970s, what you see is the picture looks pretty similar. We've added about, 3 million people by the end of that decade. 1980s, even though it was a bit more sluggish through the kind of middle part of that decade, well, it picked up and we still hit about 3 million people in Canada added to the Canada's population in that decade. 1990s, pretty similar story. 2000s, similar story. It's only once we hit 2010 where you can see at the very far right of this chart, we actually hit 4 million people added. And this is the beginning of a point in time where population growth really changes in Canada, because in the 2020 decade, here's what it looks like. We hit almost 4 million people added to the population in half the time that it typically takes to get to that population level. As you can see, this was just off the charts. We just haven't had periods of time in Canada where the population grew this fast at such an alarmingly fast clip. But the thing that's really interesting about this chart, and why I'm showing this again, I did this in a previous presentation, but we hadn't yet experienced the full rollover here. This little bit of the line going down like this now, going from the top left to the bottom right, that actually means that Canada's losing people for the first time. I mean, I struggle when I look at this chart. I can't see any other points in time where the line was actually sloping this way, which means there haven't been points in time where Canada actually lost people on net. So we right now are on a trajectory where we grew really, really fast for the first half of the 2020s. But now, as a result of government policy, we're actually shrinking. And so this is new. This is new territory. And I think personally, this is one of the dynamics that has a lot more currency in terms of explaining why things like sales and so on are slowing down. It's like we don't have the wind at our back with people coming in at the rate that we had before. I mean, look at this chart. Look at the first, half of the 2020s. You had like explosive population growth. What do you think is going to happen to sales when you have that level of growth of people, right? These people got to live somewhere. Of course, some are going to rent, but many are going to come and they're going to buy. We had absolutely astronomical population growth for the past little while, and that suddenly has changed as a result of federal policy. And that change came about, it was announced in 2024, but it starts to have teeth in 2025, and we're starting to feel it, and it's starting to show up in the data. And this is why I wanted to revisit this. So this chart is obviously for Canada, but we can look at this on a province by province basis. I just picked 6 of them here for sake of demonstration, and BC's in this panel up here. And you can see that for BC, the latest 2020 line there is starting to slope negative. We're losing people in BC for the first time in ages. Long ago, when I started this job, I was doing presentations to you guys showing charts of population growth going nothing but up, because that's where the, forecasts from Statistics Canada and so on were pointing. They were saying, well, look, based on immigration policy and demographic factors, the population is highly likely to just keep going up. This is the first time I've come to you guys and said, you know what? That's not true anymore. Now we're actually going down here in British Columbia, which is highly unusual territory. You look at Ontario, the slope's even steeper. They're losing people even faster. You can look at Manitoba, even a province like Manitoba that you always think of being pretty slow and steady. Well, it's actually losing people pretty quickly too right now. Alberta, not quite yet fully rolled over, but it's rolling over, and it's probably going to go negative at some point. Quebec, about flatlining. Saskatchewan, starting to slightly go negative. I mean, this is federal policy biting. It is federal policy finally having a very real and material impact on all of these places in Canada. It's federal policy. It applies countrywide, and we're starting to feel it. And it is the first time in history that I know of where we actually don't have this really bullish expectation of tremendous population growth behind us to kind of lift the housing market or lift the rental market or whatever it may be. It's a big shift. And I think that this personally has a lot more to do with what we're seeing in terms of the slowdown in sales than any of this nonsense with Trump and this, political stuff or whatever. Now, the other factor here that we've had going on is that was population growth, and that largely comprises a lot of, permanent residents. But we've had these flows of non-permanent residents. So I'm comparing BC and Ontario here in these panels. And if you look at this over time, non-permanent residents are people that come here and they, by definition, don't typically stay. Some might get a permanent residency, application in while they're here or whatnot. So they might end up staying, but not all of them will. So you get these inflows as represented by spikes above the zero line, and you get outflows of people periodically. And there's a sort of seasonality to it as well. There's, certain Some people will come as working on farms. And so there's a seasonality to that because the growing season is only certain times of the year. Some people will come for other certain jobs. And so there's this rhythm to it. But what you can see is over here in recent times, post-pandemic, we haven't really been seeing as much net outflows of people. And at a certain point, the federal government kind of realized, holy smokes, what's going on? Not only is these inflows significant, but we're not having outflows like we normally have. What's going on? Well, they kind of looked into it and they said, oh, I think we've got way too open of come to Canada and study kind of policy, come to Canada to do XYZ kind of policy. So right around here, they implemented new policy that said, hey, we're gonna kind of curb that dramatically. And as you can see, we are now running multiple quarters of negative population growth from this flow, specifically from net non-permanent residents. And now you might say, well, who cares? Net non-permanent residents. I mean, non-permanent residents don't buy houses. And I agree generally. And I talked about this chart in previous presentations where I was like, for the most part, this shouldn't have a tremendous impact on sales. I was kind of wrong, I think, in some ways around that. Where I said it would most likely show up first is going to be in the rental market. And sure enough, that's exactly where it showed up. If we look at a chart of the purpose-built vacancy rate for Vancouver, this vacancy rate applies specifically to, apartment buildings and things like that. It's not really like the kind of rented unit that somebody has as a condo, an investment condo or something like that. This is specific to kind of larger, investment grade or, kind of buildings and so on. This is not the mom and pop kind of thing, but nonetheless, it correlates with what's going on in that secondary market as well. And as you can see, Vancouver for eons, as far as this data goes back, it actually goes back a few years further than this, but the vacancy rate's never crossed 3% in Vancouver, despite God knows how much money and how much hand wringing and efforts from all kinds of political stripes, whether it's federal, provincial, municipal, it doesn't matter. Everybody has been trying to crack the nut of how do we get Vancouver's vacancy rate above 3%, which many for silly reasons think is a healthy vacancy rate. There's actually, funny side note, is there's not really any like serious academic research as to why 3% is a healthy vacancy rate. It's actually just a back of the envelope calculation that CMHC did some long ago that, they kind of said, well, yeah, 3%, that's good enough. But there's no like real serious academic research that like really proves that that's the right number. But regardless, as you can see, we're about 3%. We're almost at 4%. And how did we do that? How did that happen? Well, yes, there has been a lot of new rental that's been built in recent years. But I mean, I just showed you a chart of non-permanent residents where they've been falling off the map or losing them to the tune of hundreds of thousands of people, or it will be hundreds of thousands of people soon. And, those people tend to rent. So there you go. There's your answer. And now part of that, what I was wrong about before, I was semi-wrong. I'll give myself some credit. I was like, yeah, I don't think it's going to have that much of an impact on the resale market. Look, here's annual sales and so on. You can see that this number has been going up here on the purpose-built rental side. And we've had this kind of divergence between these two things where sales are getting slow and vacancies rising. And I think the part that I might have missed or underweighted mentally was that, and I should know better in some ways, because the purpose-built rental market, like I'm showing that chart there for, makes up only about a third of the rental market in BC. The other 2/3 of the rental market are made up by mom and pop investors, people with a basement suite, people with an investment condo, an investment townhouse or something. Well, what do you think happens in a market where suddenly the demand for rental falls off a cliff because you have huge population outflows of people that we haven't seen historically? We've always had more people coming in than going out. That's been the story for years. And that has been why it's been almost impossible to get that vacancy rate above 3%. And suddenly we're well above 3%, probably going to trend even higher in the future as more of these rental completions come online and so on. But think about it. What does that do to the investment market for mom and pops? Well, if you're having trouble renting out your unit, because there's kind of too much vacancy suddenly, or if you can't achieve the rent level that you need to make the numbers work, right? If you're going to buy an investment condo or something, chances are you're going to use debt. And chances are you're going to need to charge a rent that hopefully covers your debt unless you want to run a cash flow negative situation, which some people choose to do, but many people try to do it without doing that and capture a little bit of a positive spread, put some money in their pocket every month. But in a world where the population growth is slowing in Canada tremendously, I think we have a potentially reasonable argument here of why we've seen a lot fewer sales in 2025 and actually in subsequent years or previous years as well, is that, well, the investment market has really dried up. And then you add to that, right, the layers of bureaucratic, policies and stuff. Okay, no, like the foreign buyers taxes, the anti-flipping tax, some speculation vacancy. Oh my God, like it's an endless list of policies. And, you just take these things in totality and you look at it, you say, okay, I mean, they've essentially killed the market for investment. And that probably has had a very real and material impact on sales in ways that I had underweighted. I had not expected it to be that large of an effect. So I'm going to dig into that over the course of the year and see if I can actually tease out how big the effect was. I might be wrong, but I looking at these figures all together, I think there's a meaty story there that's worth unpacking and looking into a bit more deeply. So I'm gonna venture to examine that more closely in the coming years, or over the coming year, I should say. Another factor that's been going on that's pretty interesting is this concept of shadow inventory. So I get questions from media sometimes. They're like, oh, like what's going on with all these newly completed units that are sort of sitting empty that developers can't seem to sell them? And it's a tough question to like grapple with because we just don't have like super good data on what that inventory looks like, where it's spread out, what the price points are and everything. There isn't really like some one source you can go to get all of this information. You kind of have to like mash sources together, and the sources are sort of crude, I'll say, like in terms of their accuracy level. One of the sources you can go to understand this a bit is you can go to CMHC and you can pull a data series that they call the inventory of completed and unabsorbed units. So what is this? Well, this chart is showing basically how many units are sitting unsold that developers have now completed. So this is largely on their books. Now, some of these are going to be listed on the MLS. Some of these are not going to be on the MLS. They might be only available through a sales center or through some, through a website or something, right? Like this is the weird thing about it, is that it's like sort of hard, like I said, it's hard to pin down exactly, what the quantum of these look like. What are they, all 3-bedroom units? Are they 1-bedroom? There's not a lot of extra information that we can get to, but we can get a rough sense of the numbers from the CMHC data. And as you can see, BC wide, this number is at a record high, 7,500 units approximately sitting complete, ready for move-in, but they're not sold yet. And at Vancouver, like makes up a significant portion of this, as you can see, but this is a far contrast from levels that we've been at even just in the recent past. But historically, we don't tend to cross that 5,000 mark too often or ever. And, we are now at 7,500 BC wide. And for Vancouver, it's one of the highest levels that we've had in a long time. So this is an interesting dynamic that's unfolding that I think also has something to do with the sluggish sales and the resale side of things. I thought I would kind of dig into a little bit more, or try to, and I was noodling around with this the other day, and I was like, okay, well, I know that some of these completed and unabsorbed units might be listed on the MLS, and they might sell through the MLS, but nonetheless, for the sake of, just back of the envelope kind of calculations here and like sort of looking through this, I thought it would be interesting to look at something here. I was like, well, let's take the resale market. I'm just looking at the trend for inventory here. Let's take a look at that and plot that out over time. Okay, so this is what like the trend for inventory looks like in our market, the total inventory. This is what it looks like over time. And if you look at this chart, you can see that basically, right now or recently, we just hit a pretty significant high that we haven't seen in many years. And we hit a point where, we were kind of at, I don't know, a little over 15,000 on the trend or so. But this is pretty striking, in many ways. Like we just don't hit inventory levels this high. And a lot of that has to do with sales being kind of sluggish. Now, what I wanted to do, why I thought this would be kind of fun, is like, I was like, well, what if I put in the completed and unabsorbed and layer it on top of that? Now, I know I know some of these units are probably listed on the MLS, so there's a bit of a washiness there between, the line where these things kind of stack on top of each other would probably be better if they kind of overlapped a little bit. But it's hard to quantify how many of these are actually, on the MLS, if at all. It kind of depends on how strict CMHC's definition is of surveying these units, which is hard to find good answers to be honest. So anyways, regardless, what you can see is like when you add these on top, you get to this much higher level of inventory. You could call it shadow inventory if you want. And it's a lot higher than, where we've been at generally. And so that, like, all of that extra inventory, if you think about it, like probably is siphoning some buyers away from the resale market. And at the moment, that level of completed and absorbed units that are sitting vacant and ready to move in makes up almost 30% of the total of inventory here that we're looking at, of like the resale plus the completed and absorbed. Now, I know, again, there's some washiness between those two things, but you look back here, historically, we've been in periods of time where that completed and absorbed really only makes up about 10% of the market, which is why you won't hear many economists like myself or Brendan or other people like that talking about this level of completed and absorbed all that often until points in time like this, where suddenly we have this huge level of completed and absorbed units. And like now it's time to pay attention. But most of the time, it makes up a very small fraction of the total inventory. It's pretty negligible. And I thought, okay, well, that I like this concept of the ratios there. I was like, oh, let's roll with that a little bit. So what I did, I was like, okay, let's make a ratio. I'm going to call it the shadow inventory ratio. And I was like, well, let's take the completed and absorbed units, and I'm going to make some quantum of the total inventory. So I'll take the completed and absorbed, and I'll add it to the market total inventory. So I get some denominator that's like the total of those things. And I'm just going to plot this ratio here that shows over time what this shadow inventory kind of ratio looks like. I want to understand the percentage of total inventory that comprised of these brand new units sitting vacant and ready to move in. As you can see, there's this 20% line or 0.2 here. It's not a significant number by any means. There's no reason I just pulled this out, but it's like it is a threshold by which you see that this ratio is not crossed many times. And when you look back here, it was a period of time where, that ratio of shadow inventory was high. It was about 20% of total inventory. And down below, we had a correlating slow sales period. Now, causality is a weird thing here where, it could be that slow sales is causing the shadow inventory to be high. But similarly, like I was just talking about, it's like, well, it's also possible, though, that shadow inventory could be sucking away sales from the resale market. People could be choosing to buy brand new units kind of off MLS. And that could be part of the reason we're seeing slower sales. It's kind of hard. The causality is not super clear cut. More than likely, the direction predominantly probably runs from, sales to shadow inventory, in that slow sales, propels inventory to rise. But we can't rule out that it goes the other way. And similarly over here, if you look around 2013, we get another kind of moment where, this ratio hits over 0.2, and it was a time that sales were slow. And so it kind of, these things kind of jive conceptually, but interestingly, we have this big divergence here, right? We're now hitting a level on this shadow inventory ratio as 0.3, 30%-ish of, all available inventory is represented by completed and unabsorbed units sitting there ready and vacant to move into. And sales are trending pretty slowly, Causality, again, I don't know. The direction, it's hard to prove one way or the other, but it certainly is possible. And like the reason I raise this whole thing is like I've gotten questions from, media and other people being like, do you think it's possible that all this competing inventory out there might have something to do with the sluggish sales? So this is the answer to that question, essentially, is like, I think it's possible. I don't know how much that contributes, because it's very hard to quantify, but it certainly seems like a reasonable hypothesis to some degree. And, certainly interesting to see that we're at this record high on this right now, which I think it will take a while for this to get absorbed into the market. That's the other part about this that's going to be kind of interesting, is like that this shadow inventory can take a while to be absorbed. These tend to be higher priced units. Sometimes developers will offer significant incentives and so on, but they still got to turn a profit on their projects for the most part. And if they can hold and wait, they generally will. So it could take a while for that to dissipate. So the last kind of section I wanted to get into kind of relates to all of this in a way. And it's like, I wanted to revisit some of the demographic stuff that I did in a previous. I can't remember how many years ago, but it was long ago. It was like when I first started, and I thought, oh, it's probably time to revisit this because enough time has passed that changes have happened in the demographic kind of landscape of things. And I was like, it would probably be good to revisit this. And I'm glad I did because as I put this chunk together, I was like, wow, some interesting shifts happening here. So this is a chart that shows every age up to the age 90, but I've removed people at over the age of 90 from this because what StatsCan does is they do a thing called top coding where they put everybody above 90 into the bucket called above 90. And what it does is it makes this huge bar on the right side of the chart because you're lumping so many people into one bucket. So I had to remove them. So to make this kind of legible or whatever. So not including the people over 90, no offense to people over 90, incredible that you made it that far. But, this chart shows every other age group, and I've converted it to a proportion of the population so that we can say, well, what chunk of the total population is made up by each age group. And then I put some lines here, the ages of 20 and 40. Why did I put lines there? Well, generally speaking, in a kind of like, there's no like hard and fast rule around this, but if you kind of Google around or whatever, you'll find that for the most part, there's a consensus that between the ages of 20 and 40 are what we might call the prime home buying years. Because when you're about 20, you're searching for your first home, you're going to maybe get a condo, a first foot on the housing ladder. You live there for a while, maybe you couple up with somebody, maybe you have a child, you have a requirement for more space, then you level up to a townhouse, or maybe you get into a house or something. And so within these years of 20 to 40, there's a lot of life changes that happen to people, jobs, kids, marriages, whatever, this kind of stuff. And so there's a high churn of people buying and selling homes in that age category because of these life events. As you get past 40, well, your kids are probably out of the house and, you're comfortable where you are. You don't really feel like, moving too much until it's kind of necessary. So chances are you're going to slow down your housing consumption. And more than likely, your housing needs are well more than adequately met at the age of, 40 plus, if you're somebody who's owned a home for many years. You may have your mortgage entirely paid off by somewhere around that time too. So it's why they refer to this period as the kind of prime home buying years. And one of the interesting things about this is if we color code this thing by generation, and I bring in these different generations. Now, like some of them are more muted colors than others because I really want to focus on baby boomers and millennials here for the most part. So I've kind of made them the brighter colors here. So in 1985, this is what the population kind of age structure looked like in British Columbia. And you can see that the baby boomers were squarely between the ages of 20 and 40 as a generation. And not only that, as proportions of the population, the people in those age groups were the largest share of the proportion of the population. This is a big dominant group moving through this age structure pyramid through time. So pretty interesting. And you can see over here, at the time in 1985, these pink bars are the millennials, just coming up to 3-4 years old at this point in time, some of the oldest ones of them. And who would they be? Well, they're generally, for the most part, the children of the baby boom generation. Okay, so let's go 15 years in the future. Let's go to the year 2000. Now you can see what's happened. Okay, well, the baby boom generation still occupies a tremendous amount of the population. There was still a very dominant cohort of the population by age in BC in the year 2000. Right behind them is Gen X, who at the bleeding edge of it, in the older years, the older Gen Xers, they make up a kind of similar share of the population as baby boomers, but that tends to trail off to their younger years. When you look at those that were, 20 to 25, they don't make up as large of a share as those that were, say, 35 or something like that. So this block here of the boomers moving out of those prime home buying years and Gen X kind of moving in, but Gen X not being quite as large as the baby boom population, that had some interesting dynamics for housing sales and the market in general, because that baby boom generation was key to driving a tremendous amount of housing demand during that period of time in the 80s, right? And then as Gen X came into play, wasn't quite as strong, but it was still pretty strong. These are still big cohorts of the population. They're not small. They're not like, those 75 plus at the far right of this chart who make a very small proportion of the population, right? Still a very dominant driver. And over here in the year 2000, what you had was millennials knocking at the door of the prime home buying age. And this is an interesting point in time because for those who've been around long enough, you might remember that the year 2000 is when things start getting a little rowdy for Canada's housing market in general, and particularly places like BC or Vancouver. And a big part of the reason for that is you have this pretty large share of the population there, comprised by millennials, banging at the door of trying to get into the housing market, just about to get there. And they're finding it's terribly expensive and there's not a lot of supply. And that baby boom generation is clinging to properties that like they would love to own, but can't afford anymore. So there's all this frustration. And we go 16 years later. I chose 16 years so that I could capture all those millennials right into that prime home buying years. You can see what's happened. The population proportions have shifted a bit here. This millennial group now represents a pretty dominant chunk of the population for sure in those prime home buying years, and at this point in time, you might also remember 2016. This is a point in time where inventory was drained, particularly for things like condos. There was almost nothing. So over the ask offers, all cash offers, whatever. And interestingly, you can see that baby boom generation, who's largely the parents of millennials, they're in an age bracket where they've probably paid off their mortgage if they have one, and they have the financial firepower to help out their young kids into getting into the housing market. And this is, I think, part of the reason how we got such dramatic price escalation at certain points in time is that, these kids might have had pretty good jobs, but they didn't have big down payments. That probably came from, home equity lines of credit and other things like that. We could probably prove this with enough effort. But I think just as a story, it's one that makes a lot of sense. And I think when you ask around, you'll find that like many millennials have been helped by their parents to purchase their first properties or even second. Behind the millennials are now coming up Gen Z, and the leading edge of them, the older ones, they don't quite make up as big of a proportion as millennials at this point in time, but they're pretty sizable. But you can see that behind them, the share of the population at those younger age groups is a lot smaller than millennials and a lot smaller than baby boomers. And I'll talk about why this has relevance in a second. But we go to 2025, just last year. What do we see? Well, here in 2025, the millennial generation plus some of Gen Z were moved into those prime home buying years. And how did we go from the millennial generation being only about 0.75 of the population as a proportion per any bar to 0.85 or something like that? How do we do that in 10 years? Immigration. When people come to Canada or BC, largely the policies around immigration, we import people of economic viable age. We want people to come here and work. We don't want people to come here and retire and be a burden on the healthcare system by and large. That certainly is allowed under various programs and so on. But for the most part, the target population of immigrants to Canada that we try to attract as a country are people of economic viable age. And those people tend to be in this prime home buying year age brackets. And that's how we got this big boost in people of these age brackets as a proportion of the population from where we were even just 10 years ago. I showed you the charts earlier of you could see population growth just exploding in Canada, right? And we saw it in BC and other places. We just saw absolutely ginormous population growth over the past 5-10 years. And that's, a big part of the story of how we ended up at a point right now where the proportion of the population made up by millennials and Gen Zs is now significantly higher than the baby boomers and basically of any other generation in this chart. But interestingly, and what matters for the housing market going forward, is that if you look back here, the leading or the lagging edge, I should say, of Generation Z is far smaller than as a proportion of the population than the millennials. And similarly, Generation Alpha The generation after that makes an even smaller proportion. And think about what I've been showing you here. I'm showing you a chart where these bars move through time, right? They're moving through time. And unfortunately, it's the one thing that none of us can escape is time. And every year we all get older and we all somewhere, every one of us is represented by a bar in this chart. And we're moving towards the right-hand side of it. And over the coming years, from 2025 onward, if we don't have immigration, as we kind of don't now because of various federal policies, there's still immigration, I should say. They just reduced the target significantly. But it's caused a pretty significant drop in the amount of people that are coming here. And so if we don't have the booming population flows that we had before, it's kind of unlikely that that lagging edge of Gen Z and Gen Alpha and so on are going to be a significant proportion of the prime home buying years in the coming years. More than likely, we're just going to see the proportion of the population at the left side of this chart sort of marching into those 20 and 40 year age bracket, or whatever that prime home buying year bracket. And that's going to be a smaller generation of people. So that means smaller level of demand holding the population constant. Now, the population is still growing, but it's going to grow at a slower rate as a result of federal policies. So what I'm saying is the totality of all these things together suggests that over the coming years, we do not have the wind at our back the way that we had for many, many years, with population flowing into the country, but not just people flowing into the country, people of prime home buying year ages, right? That's the key here. That was just a fire hose of people coming into Canada and snapping up houses anywhere they could get it. Now, with these significant changes and a population age structure that simply, because millennials just aren't having as many kids as baby boomers did. So just from that dynamic alone, you have far fewer children in the Gen Alpha, era, just because millennials can't afford to have kids for the most part, or other various reasons. So I think this is a headwind for the market, and it's a big one. It's one of those like mega trends that I've talked about before. This is one of those ones that's kind of sleepy. You don't really think about it very often because it moves so slowly, but it is one of those core underlying trends that really drives the market here. And it's one of those things that I think over the coming years, it's going to come into play. And I feel like it's something that might create a situation where 25,000 sales a year might seem normal, or possibly even on the rosy side. It's possible. Again, I'm very fond of saying anything can happen. Lots of things can happen in the world. Lots of things can happen to change this. So this isn't a fixed sort of like that's definitely going to happen kind of prediction, but it's like, hey, the tea leaves here are really suggesting they're from a kind of demographic demand base. There just isn't going to be as much of the demand that we've had previously for housing as we had going forward. So kind of a fascinating journey through that. I hope you found it interesting. It took me a little while to whip this one together because it's a lot of shifting patterns of generations and stuff. It's hard to explain too. So I hope you were able to follow along, and I did some justice to explaining it. But so all of this kind of feeds into what I think for 2026. This is the kind of finality of this whole thing, and putting this together into numbers that we can chew on, So like I said, if you have a world where population growth is slowed, sales are slow, you have this shadow inventory that's kind of high that could potentially be siphoning off sales from the resale market as we register them through the MLS. I just look at that. I'm not trying to be dismal or something. Like, you don't have the Bank of Canada going to be dropping rates or anything. Just looking at it kind of objectively, it's hard to see a lot of near-term catalysts on the horizon that would really boost sales significantly. And that's why the forecast this year kind of looks the way it does. It's like, look, momentum-wise, we're kind of slow. So the momentum models are picking up on that. Structurally, yeah, we might achieve a higher level of sales somewhere mid-year or something like that. But initially, it's probably going to be a bit sluggish. And so overall, forecasting something like 25,000 sales for the year. Not huge, right? But it might actually be the new normal based on all the things that I've been chatting with you about. And similarly, as a dynamic, right? If you don't have a huge amount of demand and you got lots of inventory available, plus you got a bunch of shadow inventory, price growth is kind of unlikely. It's possible in certain segments. There might be certain product types like townhouses and things like that that are still pretty in demand. I'll talk about that in a second. Where you might find some price growth as a result of limited supply of that particular product type. But overall, we're looking at a market that I don't think has a lot of near-term catalysts to move the market upward significantly in price. We have a lot of inventory to chew through before we start getting into levels of inventory, like low levels of inventory that would typically be associated with rapid price growth. So I think we're really in a kind of hold steady pattern for the foreseeable future here. Putting this in a tabular format, you'll notice here, if I'm looking at sales, the one sale or the one category of sales that I could see some significant lift, I guess, from a percentage terms is the attached side. So townhouses and stuff. And part of the reason for that is going back to the demographics chart. We still have this millennial generation and some of the generation behind them in those prime home buying years, and many millennials still can't afford a house. Attached townhouses are something that are highly desirable by an age group that's kind of moving towards that latter part of their home buying years, where they would need more space because they probably have kids and things like that. And we just don't have a lot of townhouse product in and around Vancouver, or something like even like duplexes. So, the limited supply of that, I could see demographically still having significant demand for it. Is it going to be turbocharged demand? Not necessarily, because we have all these other factors that are still weighing on the market. Apartments, kind of similar, but apartments are often targeted by investors as well. And like I talked about, I think the investor market is a little bit soft at the moment, and soft might be too generous of a word. So demographically, yes, you would have some younger generations wanting to buy into apartments because they're the affordable price point. But is it going to be enough to significantly lift that number? I kind of doubt it, given that we don't have enough investors to sort of push that number higher as well. On the detached side, it's at a still a $2 million plus price point for most detached homes. I think demographically, I don't know that you're going to find a tremendous amount of demand, but it's possible some demand could come into the market. There is still development potential now on a lot of those sites, so that could be a factor that could come into play. But the development market is hitting the brakes as well. So it's not looking super bullish from the short term perspective that I can see. Longer term, 10 years out, yeah, I think things are going to look pretty good. But over the next year, it just looks pretty flat and stable. And like I said, as a corollary to this, it's basically, I can't really see many good reasons why we would put a forecast out that's going to call for significant price growth, given all of these factors I've talked about. You've got a big mountain of inventory to chew through on the resale side. You add in the shadow inventory there, however much that really is. You've got a lot of inventory to chew through, and it takes a lot of time to chew through that inventory, even when you have super strong sales, which we don't have. So it's going to take even longer to chew through that inventory to get to a point where prices start escalating at any kind of, rapid clip, barring any kind of crazy events in the world, which we cannot rule out anymore, apparently, because of this sideshow down south. It's like every day it's some new thing, and so I can't, that's just such a hard thing to even deal with there as a forecasting exercise. Like, you just can't, there's no random variable random enough that you can put in your model to capture the insanity of what's going on down south from us. And so it's very difficult to say that nothing from down there or globally is going to impact us in some significant way. This is the best I can do given the data and the information I have available to me. So that's the show. That's the forecast and everything. So if you have questions and stuff, please do email me. That's my email address there. I'm always more than happy to field questions from anybody who's got them. Oftentimes those questions are great fodder for a piece that I might write or something like that. So please, yeah, do feel free to write in. I'm very happy you were able to come today. We're going to do a Q&A session now live. So if you want to stick around, you're more than welcome to, and I can take questions. The way it's going to work is I have an assistant lurking in the background who is going to kind of filter the questions for me. And so if I don't read your question, just please email me or whatnot, and don't take any offense. I'm only seeing the questions that are getting fed to me somewhat randomly. So, I'll do my best to answer what I can out of those. And, yeah, so if you have questions, just type them in the chat, and we'll get going with that. Let me just get out of my share screen here. Okay, that's a little better. See if I can, I can't quite recall if the, okay, so I've got a couple questions here. I'll start with the oldest ones first. Curious what the forecast is based on. That came in around 10, which was an hour ago. So guessing that was earlier in the conversation. I'm guessing that question's probably been answered by the presentation. So I'm going to skip that one. Curious what you think about the macro situation with BRICS and US de-dollarization, et cetera. Do you think liquidity will move to real estate along with precious metals and maybe even crypto? Yeah, that's a great question. So full disclosure, like my basket of things that I'm invested in, I certainly hold some crypto. Obviously, I have some real estate. I own a home. Precious metals, not something that I've ever been too keen on. I've always found it very hard to predict, what might be happening in those particular markets. They're driven by very complex geopolitical factors and things like that. Very hard to guess. I do think that in a world where if the US and other countries start adopting things like crypto as reserve, and they have strategic reserves of this, that's a hedge against having a world where the US dollar is no longer the dominant dollar in the world. And with China being incredibly powerful at this point in time, I wouldn't say that China's dollar is going to supplant anything anytime soon, but you have these big global dynamics happening right now that's putting a lot of pressure on the existing framework, the global monetary framework that we've come to know as everything that it is right now. This world where the US bond market and dollars are the number one, the gold standard of everything. In a world with what's going on with US politics, you've got this kind of crazy sideshow down there that's this horrible scandal of Epstein and all this sort of thing, taking down all kinds of political figures around the world and whatnot. It's certainly possible that we're moving to a world where the US is much less of a dominant player in that. And in some ways, US policy is moving towards that world anyways, out of their own volition. They want to be a lot more, protectionist. They're slapping tariffs up on everybody and this and that, and they want to kind of be their own, island in the world. Fine, but people are going to move off your standards then. People are going to go to other dollars and whatnot. So yeah, I think there is something to that. I think there's a potential for a pretty big shift. I don't think it's going to happen overnight. Again, super hard to predict because of the insanity of what's happening down south. But yeah, I think it's a good question, a fair one, and hopefully the answer kind of gave some justice to it. But it's really difficult to forecast something like that. If I knew, I'd bet more on it. I'll tell you that much. I have limited amounts in all of those things, trying to hedge my bets with some diversification. But anyways. So for the pop growth chart, is the shrinking due to age demographics such as aging baby boomer, or is the pop growth only reflecting immigration data? So yeah, that's a great question. It's both. Yes, we have this large boomer population. They're not all, the bleeding edge of those, the oldest, are somewhere around 80. So, yes, mortality is starting to come into effect, but people are living longer these days and whatnot. So, it's really not, I wouldn't say it's a mortality driven effect presently, although as they age over the coming years, it will be a much more significant factor. But the thing that's really curbed the population growth over the short term, over the past, is this policy driven effect where the federal government consciously has made a decision to dial that back significantly, particularly on the net non-permanent resident side, but also even on just the general immigration targets. That's been curbed, and so that's really having a pretty big important effect on the market. And as I was pointing out too, with that population age structure, the part that kind of matters from a real estate perspective is that, like, if aging baby boomers are dying off and whatnot, or the people at the far right edge of the plot of the population age structure are dying off, it's obviously sad and whatnot for families and everything, but that's not a tremendous driver of housing demand. Those people at that age group are often downsizing, or some are going into seniors housing, which is a form of rental often. So it's not, we don't see a lot of demand from that section. Where the demand comes from is that those people of viable economic ages, 20 to 40, that's where a lot of that demand's coming. So when you pull the lever and you say, hey, we're not going to have as many of those people, that's where I think we're having some real flow through into the housing markets, and we're seeing it across many places in Canada as well. It's not just Vancouver. So I think that's kind of where things are at with that question. Will the government make any changes to the foreign buyer rules? I wish I knew. I would hope that they would, given that like we have a situation right now where you have population growth slowing, a vacancy rate north of 3% in Vancouver, which we've never seen, historically. The argument for really, aggressive demand side policy measures that we've had, short-term rental restrictions and all of this other stuff, all these layers of it, the argument for those policies becomes weaker and weaker and weaker the less the housing market kind of performs in the sense of being, very bullish or whatever, if you want to put it that way. Like, when you don't have sub 2% vacancy rates chronically, and you don't have prices escalating at 10% a year or whatever, it just becomes a lot harder to justify those kinds of policies. They may be unnecessarily keeping a lid on a market that doesn't need a lid on it. The argument could certainly be made whether the market ever needed a lid on it. I don't know. That's a whole other can of worms, but an interesting question. When assessing monetary policy direction, labor market strength, and inventory dynamics, it's not yet clear to me that we're seeing the type of alignment that historically signals a transition back to a seller's market. I'm asking in part because I'm observing many homeowners choosing to remain on the sidelines, operating under the assumption that 2026 will naturally bring a rebound. My concern is that in the absence of clearer macro catalysts, prolonged softness could continue, and in some cases, waiting for a perfect window may result in further price erosion rather than recovery. From your perspective, is that a fair risk assessment, or do you see structural forces building that could materially shift the trajectory? Excellent question, and wow, very nicely written. I must say, it's kind of nice to read through. So exactly. I mean, yes, I do not see a tremendous amount of macro factors or catalysts on the near-term horizon that I think are going to move this market, especially in terms of pricing. If you have a client sitting on the fence saying, well, I think I could, the market's going to be higher a year from now. Realistically, I think, some of the information that could be helpful for you to advise your clients about on that kind of question is like, you can pull the shadow inventory data yourself. You can show them that there's a record number of completed and unabsorbed units sitting on the sidelines that are brand new, and yes, they're coming at higher price point, but whatever product you're sitting on has to compete with that in the market right now. And so not only do we have a record, or not quite record anymore, but very close to record high level of inventory in the resale market, we also have this shadow inventory sitting there on the sidelines, which calls into question very seriously whether, we're going to see any kind of price escalation. Because to get to price escalation, you can also show clients this. It's fairly easy to, pull the information to show them. As you show them that the points in time historically where prices rose rather rapidly or even rose at all in our market are points in time precisely when inventory was extremely low. And you can show them just how high we are right now relative to that point in time. And it's, I think that's a fairly compelling picture, in my opinion. I'm not a realtor, so, you do your magic as well of trying to, sell them on that idea. But I do think it's a very powerful concept because it really is quite a striking chart when you look at something like inventory and just average price or something, or an HPI over time. You can very clearly see that it's the periods of time where inventory is super low where prices rise very rapidly. And in periods where inventory is high, you often get either flat prices or actually declining prices. So for anybody sitting on the fence that's waiting around, it's going to be better next year, this and that. I'm not saying it's going to be horrible. I'm not saying that there's going to be, necessarily price declines. I just really struggle to see a strong argument of why we might see any significant price escalation. So kind of best you can do is probably, try to thread the needle kind of gently with your clients on that one and try to explain the nuance of that. But I think you're right. The absent big catalysts on the near-term horizon, there's not a lot of good arguments of why we might hit that kind of trajectory on prices. Another question here. The vacancy rate is increasing. Will government make changes to the speculation vacancy tax? I would hope so, they the BC government's in an interesting place as well right now. Politically, I kind of follow this peripherally. I used to work for the BC government in the policy shop that did housing. Don't blame me for the problems that we have. I didn't have anything to do with it. I was trying to tell them not to do certain things. They didn't listen to me, and so I quit. But anyways, the where they're at right now is a tough spot. EB's got a record deficit. He's politically probably at the end of his term. This is just my kind of off the cuff assessment, and it's nothing personal against EB or anything like that. Just politically looking at the situation right now. The other thing is that he doesn't really have going for him anymore, which I would say was a big driver of what really pushed him into power. It relates to what I showed you in this presentation. I showed you that demographic age structure chart. Around 2016 was peak frenzy in our market. You had over the ask offers, just no subjects. Like it was just a bonanza out there in the real estate market. And you had this millennial generation, as I showed, trying to get into the housing market. And they not only were they a big driver of housing demand at that point in time, they also happened to be an important voting bloc. And so you have this generation of people at that point in time who were pissed off, quite frankly. They were like, look, this is ridiculous. They're like, we're trying to get into the housing market. I go to see a condo. There's 300 other people lined up to see it. It goes, 10 offers over the ask or whatever. And they're just like, this is ridiculous. Do something about it. So EB and his government put together, the 30-point plan on housing affordability, all this stuff. They slapped together, any hodgepodge of housing policy they could think of to dampen demand, and they get elected. They get elected on that. But the thing that's happening right now, like I showed, is like, well, that millennial generation, yes, many of them are still struggling to afford housing, but many of them are actually in the housing market now. Partly as a result of intergenerational wealth transfers. You have, the baby boomer parents who probably don't have a mortgage, and they're, using their HELOC to help a kid get into the housing market. So now that generation is in the housing market, and they're sitting there being like, well, these policies don't benefit me anymore. Like they don't want a speculation vacancy tax. They don't want all these rental restrictions. They don't want the short-term rental stuff all that much, because they're in the housing market and they need ways to pay the mortgage. So they want to find ways to bring in more income, and all of these demand dampening policies aren't really serving them. And you have this generation behind them that's even smaller, who's going to have less of an impact. So like I said, I think that the situation for EB and his government is that I don't think they have the backing of that millennial generation nearly as much as they used to, because they're not as upset anymore, because many of them are actually in the housing market. Now they want policies that favor them, ones that take off these restrictions on the housing market. So yeah, I think there is a potential for sure to see something like the SVT rolled back or something. SVT questionable, because that one's somewhat profitable for government. Once they start making money off of something, good luck rolling it back, but something more like short-term rental restrictions and stuff, I could see that getting dialed back a bit or something, or kind of cooled off a bit. But we'll see, and it really depends on if we get a new government. I could see a conservative government or something coming in, or conservative adjacent to whatever that might be, in the future. I could see a group like that coming in and winning an election largely on a platform of kind of undoing a lot of the stuff that the BC NDP have done in terms of that housing policy space. Whether that happens, we'll find out. I have no idea. When was the last time we saw shadow inventory at these levels? Good question. Never. We've never seen shadow BC wide, never been this high. We've never had 7,500 units or more sitting unabsorbed on the developers' books. It's never been this high. And you've probably read, news stories and things like that of developers talking about this situation, saying that we're not, with all this inventory we have, we're not doing new projects. We're not starting them. We're not even thinking about it. We're barely even thinking about buying land for them, because they look at similar information as I just presented you. They look at demographic structures. They're trying to predict demand 5 years out, because that's how long it takes to build something, and it's hard to do. And when you look at the picture that I just painted for you, it's like there isn't this super strong picture of a lot of demand in the near future, especially for new expensive product. So they're going to pull back, and chances are we're not going to have nearly as much development in the near future, especially over the short term. And it's probably going to take a significant rebound in immigration and things like that for us to see demand for new product and so on pick up again. So that shadow inventory being so high, elevated at the BC wide level, it's pretty high for Vancouver. I don't know if it's the highest it's ever been for Vancouver, but you could go back. I'll share the deck afterward. Excuse me. I'll share the deck afterwards, and you guys will have all the slides. You can look at check it for yourself. But I think it's near the highest it's ever been for Vancouver as well, and it's like that's a lot of inventory sitting around that's brand new and it's just ready to move into. And you know, you don't have to, when it comes to showing it, it's not like you even have to bother anybody, right? You don't have to get a tenant out of it or anything. You just go see it. And so, you know, it's pretty competitive. And with developers offering more and more incentives on those things to try to move them, you know, it certainly could be competing with the resale market in a meaningful way. Other than StatsCan, what other sources do you frequently reference for demographic data? StatsCan is like the, you know, kind of the gold standard, I would say. They really like they're the most able to pull together these kinds of complex data sets relating to population age structures. Like they, first of all, they're the ones that have the issue the census. So this is where we get one of the more the better reads on population age structure, because we ask people directly on the census, what's your age, you know, whatever. They also have access to things like health, certain kinds of health records. So, you know, births, deaths, these kinds of things, they'll be able to track through various, you know, provincial registries and this and that. They have access to immigration flows from like the immigration refuge, or what is it, IRCC? Can never remember what it stands for, but it's the it's like Canada's immigration I don't know what ministry or whatever you want to call it. I don't know. So there's like a bunch of data sets that they pull in to try to build these data sets around population. And I would say, in my opinion, like they're probably best positioned to give a reasonable read around or on what's happening in that kind of narrow aspect of population and demography. There are probably other sources out there, to be honest. I haven't really looked around because I've personally always found StatCan to be excellent for this. They also have, you know, plenty of literature, and they also issue like forecasts on population and so on that internalize these big factors. Like right now, I did this in a previous presentation. I showed a chart, an updated chart of StatCan's population projections as a result of these federal policies. And you can see this kind of like dip in the trajectory, which wasn't there before in earlier forecasts. They were just like a straight line up. So, you know, definitely recommend noodling around StatCan quite extensively. And if you can't find what you're looking for there, then, you know, maybe expand your search after that. But I would say StatCan is really your go-to for that. Jim Baker asked, what does H1 represent? Good question. I should probably like make this more obvious, but we do a first half and a second half. So H1 is first half of the year. H2 is second half of the year. I do like an H2 update to the forecast where we kind of take stock of what happened in the beginning of the year for the first half and say, oh, like how far off are we on our forecast? Do we need to make an adjustment to it, this or that? And so I'll usually put out a document or sometimes do a, you know, another presentation like this or whatever, where we walk through that and I, you know, guide people along. But that, shortly, yes, that is what that means. So with year to date, January 1st to February 11th, board sales down about 20%. Is this forecast potentially overestimating things? Well, I showed you a chart earlier on in the presentation, and you may have missed it. I don't know. It depends on when you logged in, but it was early on in the presentation. It was one of the second charts. And it showed how this year's forecast compares to last year's forecast. And I showed what the actual was for January. The forecast we put out this year for January was expecting about 1,000 sales. We came in at 1,100. So we're actually underestimating the level of demand out there right now based on the forecast. But, you know, this is early days and we'll see what happens in the coming months. You know, like it's certainly possible that we've overestimated again. I'm very hopeful we have not overestimated again. I've really tried this year to situate the forecast in territory that I think is very realistic, not necessarily rosy or optimistic or not too pessimistic either, because, you know, one of the interesting things there, I had this whole section that I was going to present on that was like a comparison between Vancouver and Toronto, but the presentation would have been way too long. But like one of the interesting things I could say about that is like Vancouver's market is holding up significantly better than Toronto. We have way less inventory like than Toronto has seen in terms of the increase of inventory, at least in percentage terms. We've had far less of a price correction in Vancouver, and sales, while not great, are still kind of like chugging along, you know. And a big part of that is that demographic, you know, structure of things. There's just people moving through life events that need to move for various reasons. And like that is one of the key reasons we still have so many sales. It's just that. But what we don't have anymore, or what we don't seem to have as much of, is that kind of investment driven demand, or other forms of demand, people buying the second property or the third property or whatever, or the person buying the investment condo. That seems to have really tamped down in recent years. And, you know, for a variety of reasons. And I think that's kind of why, part of why sales are as slow as they are. So I think I'm hopeful that we're not overestimating. I think if anything, I'm hopeful we're underestimating this year. We'll see. I'll update you in H2. Do you see geographical variation of note for increased sales figures, i.e. North Shore versus Valley? Yeah, absolutely. This is a good point. In these presentations, I tend to speak at the high level, at the kind of market total level, because the trends occurring at the market total are like literally by construction a reflection of all of the submarkets. It's all rolled up into a market total number, but it washes over the fact that there is obviously significant or can be significant regional variation in some of these markets. And we've definitely seen certain markets in Vancouver region that have been doing a lot better than what the headline numbers are suggesting. But we've also seen ones that have lagged a bit. And so on average, you know, that's why I talk about the total numbers, is because like it kind of is a reflection of the market as a whole, is more of a general vibe. But yes, you're right. There is absolutely more geographical variation. And I've thought about, you know, trying to present on that. It gets challenging because we have so many different submarket regions. And like, what am I going to do? Put a 5-hour presentation together going through, you know, every single one of them? Is like, I don't know. But I have thought about one way of kind of addressing that is maybe I'll write a piece or two here and there and spotlight certain markets that are really, you know, on either side of the spectrum, like really outperforming or really underperforming or something like that. Not to highlight underperformance, but just to sort of compare and contrast of like, you know, what are the drivers and what are the different dynamics that are happening in these markets that are not quite like the rest of it. So I'll take that into consideration, and I'll definitely see if I can cobble something together in the coming year that might kind of dig into the meat of that, so we can, as a group, kind of share that perspective around the regional variations. Do you expect any policy shift from local or federal government, like removing foreign buyer ban? Yeah, I already kind of answered this question a little bit before, but essentially what I was saying is like that it's quite possible there might be, you know, a shift in government here. That shift in government could potentially roll back certain policies at the federal level. Kind of unlikely that they're going to roll back much, but never say never. You know, really depends. But yeah, like I did already answered that in a sort of longer format. I want to grab other people's questions here while I can. So, do you think high-end hotels facing international markets will be a decent hedge against the fundamental weakness in Canadian productivity / household incomes, and therefore weakness in the residential and industrial markets? Ooh, travel. Man, I don't know. You know, travel's a hard one to predict, right? Pandemic happened, everybody's like, travel's dead. Then everybody's traveling because everyone wants to flee the place that has the most COVID. Or you know, man, what a tough one to predict. Would hotels be a good hedge? Uh, you know, I don't think I have a sufficient level of understanding around the hotel industry to answer that question with any justice. Like, I think what you would need to do is you'd need to really dig into the kind of market structure of hoteliers. Who are the largest players? What are their stock prices doing? Read through their board meeting notes and stuff, learn about the fundamental drivers that they're witnessing of changes and shifting patterns of travel demand. That's where you'd probably have to start your journey. Whether it offers a good hedge against these things, I don't know that there's anything that's a great hedge. Like the best hedge is a diversification of some sort, which obviously means you're going to forego better returns. That's the whole point of diversification. You get less downside, but you get less upside. So adding hotels to your basket, probably not the worst idea if you don't have any in there, you know, but, you know, don't overweight it is, I guess, what I would say. What is your anticipation for the Kuzma review? How will it affect the housing market? Yeah, so the good question. I don't know what's going to happen with Kuzma right now. You've got Trump saying he's going to bow out of it, whatever. I don't know. The guy, he was part of the agreement of it, so it's like what is Trump going to do on a daily basis? I have no idea. But what I can say is, like, I showed this chart of the economic policy uncertainty, right? We had this huge spike in that, and it maybe or maybe didn't have an impact on sales, but we had this decline in that metric recently. Like, policy uncertainty per that metric has dropped off more than half, but we haven't seen a commensurate uptick in sales. So I'm sort of skeptical of the notion that we're going to see, as a result of any kind of policy agreement or something out of the United States, I'm skeptical of the notion that that alone is going to be sufficient to just drive the market upward, or have a ton of people flood back in on sales. I personally, if I had to bet money on it, I think those factors are more peripheral than the big structural factors that I was talking about, like the immigration flows. I think that has way more significance and weight in terms of what we're seeing on the ground than any of this nonsense from the United States. Since the development activities are almost halted, how soon will the lack of new supplier be felt? Good question. I was going to do a chart on this, but it was going to make the presentation too long. But it's a good chart. I did this chart at the Pacific West conference, where I showed different periods of time historically and how long it took inventory to go from like a peak to a trough. And in many cases, it took years. Basically, it took years to chew through that. And in our current situation, not only do we have a really high level of resale inventory, but we also have this shadow inventory. Even with developers halting all actions together, if that were even a thing, if they just stopped completely building right now, we'd still have, it would take years to chew through the sales, or chew through the inventory at the rate of sales that we're at. To go faster, we need sales to dramatically increase. And as I pointed out through the presentation, I don't know that we have a ton of factors that are going to move the needle in that direction. There's two more questions here I think I can try to answer. We got 2 minutes left, basically, technically. But like I said, please do email me if I didn't get to your question or anything like that. I'm more than happy to field questions anytime via email or whatnot. Second to last question was, what's the update on the first-time homebuyer GST rebate program? Is that a done deal, or is there a possibility that it'll be amended? You know what? I don't know the answer to that. I thought they were going through with that. Last I heard, that was all, everything was copacetic. So if something's changed, I'm out of the loop. I'll have to find out myself. And the best way to figure out is just Google it. That's what I'm going to do. Sorry, I wish I could answer your question. I should probably know the answer, but unfortunately I don't. Can you do another seminar on what you just mentioned, how Vancouver is holding up against the rest of Canada? Yeah, I think what I'll probably do is, instead of a seminar or something, I'll probably write a piece on it. I think it's a very interesting comparison. I think I did write a little bit about this. I think I have one or two pieces out that have some comparison in them, but they focus on some other elements. But it would be cool to do one that just really like digs into a cross country comparison or something like that. That's a good idea. I'll add that to my list of I have this long list that I keep of like ideas to write about or whatever. I'm never short of them, but I love when I get great ideas like that. That's a great one. I'll put that to the list. How do you think the FIFA World Cup will affect the housing market? Do you anticipate a decline in sales in the following years? Not necessarily. I mean, I think those kinds of events are often good for visibility, and so I don't know. Like, I think those are like really acute sort of shocks to a housing system from like a hotel, demand and rental demand and things. But then those shocks like dissipate quite quickly after an event. And so they don't tend to have like super long lasting effects. The bigger effects that are going to like have some material impact on demand or the housing market and over longer periods of time are really those ones that I was talking about here in this presentation, that can be sort of boring and dry to look at because they're such slow moving things, like population, right? Or demographic structures, like age structure of the population. Like, this is just painfully, it's like watching paint dry on a wall. It just takes forever for something to change in there. And like, that's why I wanted to present it here, because last time I presented something on that was like a couple of years ago, because finally enough time had passed that it's like worthwhile, presenting the chart. But I think those are the things that are really going to be the drivers in the future for us. I think it's the area, if you want to pay attention to what's happening and what is most likely to drive our housing market in the future, I think the places to look are really in those demographic trends, the immigration trends, those kinds of things, because those are the big mega trends that really drive things under the surface of it all. We always have this noise everywhere. We always have political uncertainty, some new government, some new policy, some new this or that, whatever. But all of those things are just noise around a bigger monumental shift that is always kind of occurring under the surface. And that is those big drivers like demographic, generational demand, those kinds of things. So pay attention to those if you want to know where the market's going long term. If you want to understand where it's going short term, sure, pay attention to the noise, of course, because those are the things that drive things over short term. But long term, it's really those big mega trends that I try to focus on that I think are, the biggest factors. So that's all the questions. That's all the time we have. Thank you all so much for coming. I really appreciate it. It's so nice to see so many participants in the conversation here and all these great questions. I really appreciate all the great questions. I think we are probably going to send out a survey afterwards. So if you get a chance, do please fill out the survey. I love getting feedback from people, whether they enjoyed it or had aspects that they wanted to see, didn't get to see. So yeah, do send me a note or whatever, and I would be thrilled to see any kind of feedback or whatever you might have. Or if you want to just send direct feedback, send me an email, sure, or a question, whatever. So really, thank you so much, everyone, for coming, and we'll see you at a future event. Have a great day.